So suppose you are an investor and you own shares in Amazon and you want to hold your stocks for the next 10 years to exit probably in the year 2031, then you're going to be looking forward to selling your shares 25 times EBITDA. So that is the terminal exit multiple, because you believe that you will sell your shares by the end of that year in the year 2031. So in this case, we're going to be selecting the exit multiple as our terminal value, since we will be determining the net present value based on this terminal value methodology. So it could be, we can select either the exit multiple if the stock is going to grow in perpetuity, say past 2031, then you estimate that since it's a high growth company and the stocks will grow constantly in perpetuity, then you can we can use this terminal value methodology instead to determine the net present value for the terminal value. And if in case we want to use the hybrid of both, then we will take the average for the exit multiple and the perpetual growth terminal value. So that's exactly what we are seeing here. And it's very, very important for us to understand these concepts. It's very, very important because for perpetual growth, we use the Gordon growth model to determine terminal value. And of course, the long-term growth rate, it's something that we have to look at, we have to pay attention to. So like we said before, since the net earnings, the net income of Amazon is growing, so it's a high growth company, and we can see that the net income is growing probably at an exponential rate. Then exactly what we want to do, well, we just place an assumption here of 4%. But if you want to know how to determine this, since the net earnings are growing and Amazon is a high growth company, and of course might not pay dividends, so you might not have that dividend information on high growth stocks. So we can instead use the net earnings to determine the growth rate for Amazon based on that. But if we were to use the dividends discount, the dividends Gordon growth model to determine if we were supposed to use the dividends method to determine the growth rate for the long-term growth rate for Amazon, then we will have to focus on the cost of equity capital formula, which takes into account the year after dividend, and then we divide that by the current price of the stock. And then, so if we have that information, if we have the cost of equity, we have the dividends for the next year that needs to be paid, we also have the current price of the stock, then we can reverse engineer that cost of equity formula to determine the long-term growth, since it is embedded in that formula. So, for example, the cost of equity is equal to, we take the next year dividends divided by the current price of the stock plus the long-term growth rate. So now we can substitute the long-term growth rate to determine that growth rate. So we can now just use that, just reverse engineering the cost of equity formula. Otherwise, we could also use the net earnings, as we saw, the net income, since it's going at exponential rate. We can use that to determine the long-term growth based on that. So it's very, very important for us to understand how we determine the long-term growth rates to later on calculate the Gordon growth model for cash flows that will grow in perpetuity. So let us just rename this long-term growth by going underscore long-term So let us rename this long-term growth by copying this and pasting it here. So we have this renamed as long-term growth, so we can just copy that and paste. So we have that set up there. Now we can determine year. So we're going to go by VLOOKUP, this terminal value methodology toggle, VLOOKUP, where we are looking for this drop down terminal value methodology. References start with F for ones. We are looking for that year. The references start as well, and then let us assign an index of 1 in this case, and then an exact match of false. So we have that set up.